Hey there! So let's talk about business, but not the boring spreadsheets until our eyes glaze over kind of way. Imagine a company isn't a building or a logo, but a giant, sprawling network of pipes. Through these pipes flows the lifeblood of the whole operation, cash. We'll call it the cash flow pipeline. Money comes in from customers. Whoosh! It flows through the system to pay for salaries, materials, those fancy office plants. What's left over can be used to build new pipes, expand the network, or be returned to the people who own the pipes. It's a beautiful system when it works, but here's where it gets interesting and a little scary. Sometimes these pipes spring leaks, tiny drips, massive gushers. Money that should be sloshing inside starts seeping out. Maybe the company is spending way too much on things that don't help it grow. Maybe customers aren't paying their bills on time, creating a blockage in the system. If you're not watching the actual flow of cash, you might not notice leaks until the system runs dry. That's why understanding cash flow is so fundamentally important. It's the real, tangible measure of a company's health, not just a number on a page. Now you might be thinking, but what about profit? Isn't that the whole point? Excellent question. Profit, or net income, is what's left after expenses are subtracted from revenues. It's an accountant's view of performance over a period. Accounting has rules, lots of them, that allow for things that aren't strictly cash. For example, a company can record a huge sale as revenue even if the customer hasn't paid yet. That makes profit look amazing. But the cash pipeline is still waiting for the money to arrive. Profit is like a photograph of a runner crossing the finish line. It captures one glorious moment. Cash flow is the full video of the entire race. It shows if the runner stumbled, if they had to stop for water, if they were running on fumes for the last mile. It tells the complete, unvarnished story of how the company actually generates and uses its money. That story is often far more revealing and much more dramatic than the simple profit snapshot. Let's dive deeper into this whole profit versus cash thing, because it's the source of so many financial mysteries. The biggest, brightest, most flashing neon sign of a red flag you can ever find is this: a company that consistently reports strong profits, beautiful profits, growing profits, while its cash flow from operations is weak cash flow, negative cash flow, shrinking cash flow. This is the financial equivalent of someone saying they're a world-class chef while their kitchen is on fire. Something just doesn't add up. Income statement, painting a masterpiece. Cash flow statement, revealing a disaster. So how can this happen? Remember those accounting rules we talked about? They create a gap between reported earnings and actual cash. A company can boost profits by aggressively booking revenue for sales made on credit. Income statement cheers. Hooray, a sale. Company's bank account, here's crickets. Another classic move, delaying payments to suppliers. Not paying bills holds on to cash longer, which can temporarily make the cash position look better. But it's not sustainable. Like holding your breath to save oxygen, eventually you have to exhale. This disconnect is why cash flow is the ultimate truth teller. It strips away accounting assumptions and non-cash items, like depreciation, an expense that doesn't actually involve paying out cash, and shows you what's really going on. Net income equals sign company's GPA. Looks impressive, but doesn't show if the student is learning or just good at tests. Cash flow from operations equals sign the student's part-time job earnings. It shows if they can apply skills in the real world to actually make money. A company that can't turn profits into actual cash is, to put it mildly, in trouble. Over the long run, profits and operating cash flow should move in the same general direction. Like two friends walking down the street. They might drift apart for a moment, but they generally stick close. You need to be very, very suspicious. All right, let's move beyond the core operations and look at how a company invests its money. This brings us to capital expenditures, or, CAPEX, to add to our detective kit, and these are often signs of desperation. The first is a company that pays dividends while its operating cash flow is negative. Now, dividends are payments made to shareholders, a way of returning profit to the owners of the company. It's a nice thing to do. But it should only be done when the company is generating plenty of surplus cash from its actual business. Paying a dividend when your operations are burning cash is like throwing a lavish party on a credit card when you've just lost your job. It's a move designed to keep up appearances. Management wants to signal to the market that everything is fine. Look, we're so healthy we can afford to give cash back to our shareholders. But the cash flow statement reveals the truth. The cash for that dividend isn't coming from successful business operations. It's a classic case of financial window dressing. Our final red flag is a bit more subtle, but equally concerning: investing section, financing section. For example, you might see a huge cash inflow from selling investments one year, which conveniently plugs a hole in the company's operating cash flow. Or you might see complex transactions where cash moves back and forth between the company and related entities. These kinds of moves can be used to obscure problems or artificially inflate a company's cash position for a short period. When you see these big, lumpy, and often confusing changes, you have to ask, what is really going on here? You need to become a cash flow detective. Look past the shiny, headline-grabbing profit numbers and dig into the nitty-gritty of the cash flow statement. This is where the real story of a company's health, written in plain, hard numbers. It's the ultimate lie detector test for a business. Ultimately, the cash flow statement empowers you. Follow the cash, because cash flow never lies.